Hi guys, welcome back to the channel. So today we're going to be covering moving averages. I'm quite excited to show you guys this. The reason being is because within our trading team we use this very differently. So to the best of my ability, I'm going to try and show you guys everything as much as possible. And without further ado, let's get moving moving average. Right guys, so today we're going to go over moving averages. So just for your guys' peace of mind, the moving averages we use is the EMA 8 and the EMA 14. As you can see here, EMA 8, EMA 14, both getting applied to the close. So for your guys' benefit, I'm going to go into my settings. The indicator we use here is called the EMA ribbon. What this does is it allows you to have 4 moving average indicators in one thing as opposed to having to use all 4 if you don't have Pro, for example, right? So your metrics are as follows. Your number one EMA, you selected EMA, which is exponential moving average. That's applied to the close at 8. You pick your color, right? Mine in this case is yellow. Then you have your second EMA to the close, and you make that metric 14, right? Mine is green in this case, right? Then you have the SMA. This is the simple moving average. You also apply to the close, and you have it at 50, right? Then you have another SMA, also apply to the close at 200. So I'm just going to leave this here for a second so that you guys can see everything. Just make sure all your moving averages are the same as mine, right? Cool. And then we'll get into it, right? So to paint a picture for you guys, the yellow line here is my 8 MA. The green line here is the 14 MA. So we first going to go through those two things, right? So when the 8 is above the 14 MA, we are in a bullish market. As you can see here, my yellow line is above my green line, right? When the 8 is below the 14, we are in a bearish market, right? So what you guys can notice here is I'm just going to take away these MAs quickly, the 50 and the 200, just for the sake of this exercise, right? Right, so this one thing about the 8 and the 14 is, and it's something you guys will notice quite frequently on the lower time frame, like let's say for example the H1. And if you're looking to catch entries, like you see the market made a falling wedge down here, we got a little crossover here, and then the market pushed upward, right? So the one method is to wait for the 8 MAs, the 8 and the 14s to cross on higher time frames. When I say higher time frames, I mean anything from daily to 4 hour. When you get crossovers of that too, it generally means the market will change direction, like completely, right? So an example of that is here we got a little upward move. The 8 was still above. The 8 and the 14 crossed over. Bam, we got a bearish engulfing candle, and the market just melted from there. Adversely, we came up. Here the 14 crossed with the 8 again, bang, and it went up, right? So the number one way to use it is to use the crossover. However, with that being said, right, there is also a special thing about the 8 MA. What you guys will notice is the market tends to come test the 8 MA. So the 8 MA in general sort of keeps the trend healthy. That's how you need to look at it. So when the candlestick bodies move too far away from like the actual MA, the 8 MA, it tends to cause retraces to happen. As you can see, every time the market pulls away, pulls back, pulls away, pulls back, pulls away, pulls back. You'll see it frequently, even on a downtrend. The market pulls away, pulls back up, pulls away, pulls back up, and you'll notice it keeps testing the 8. Occasionally it does test the 14, but on high time frames under normal circumstances, you're always looking to catch it off the 8 more. So for example, on the daily chart here, as you can see, the 8 MA is now far away from where the candlestick body is. So what might happen either on a lower time frame or on this time frame, one of two things will happen. The market will pull downward to catch the 8 MA and shoot back up again, right? Alternatively, what it can do is the market will range. So a 4 hour would literally move something like this, not really break much, accumulate orders until the 8 has caught up on the daily. So that's just, remember, on a daily it could take a little bit longer, and the move could actually continue upside, and rest above. Then when the bodies find support, so for example here, right? If we can find support here, for just an example, guys, if we find support there, what would happen is the market would then, the next candlestick would then retrace, maybe pull up, pull down, pull up, pull down, and then what happens is it causes the 8MA to catch up. The minute the 8MA gets close to the body, the market will continue on its bullish momentum. So that's kind of the major key factor. You kind of, if you're looking to trade off of the 8MAs as your main kind of source, or 8 and 14 in fact, always wait for a break, a retest of one of the two before you get in. Because look at this, for example. Here we got our confirmation candle, maybe because we're below, we don't want to take it, right? Then it broke upward. The minute it broke upward, came down to test. What did it come test? The 8MA. Bang, and it confirmed. You could get in from there, right? Reason being is that because we retested there, your stop loss would be somewhere down here. And if you were someone that uses Fibonacci tool, you would use something like this, and you'd go to this area, right? And as you can see, we might hit our take profit very soon had we taken the entry, right? So that's just like an indication of how you can use the 8 and the 14 on its own, right? The one thing to remember about the 8 and the 14 though, it is more current moves. So it's kind of holding the trend at bay in the shorter term of things. So that's how you need to think about it. 8 and 14 is more the right now. Then the exact opposite can be said about the 50 and the 200, which I'm going to put on my chart now, and I'm going to remove the 8 and the 14, right? So the blue line is my 200, the red line is my 50. So two things here, guys. The first thing is when the candlestick body is below the 50 or the 200, we are in a bearish market. As you can see here, we were below. What happened? The market fell down to the downside. When the candlestick body is above the 50 and the 200, we are in a bullish market. Now, you get this very, very cool thing called golden crosses and test crosses. So golden cross is when the 50 goes above the 200, right? And that creates a bullish momentum. Then you get the death cross, which took place right here, where the 50 goes below and it causes the market to drop. Because look at this. Yes, we might have missed the sell, for example. Now we wait because the market's ranging a little bit, comes in, breaks the 50, nicks the 200, shoots back down. But at the same time, we get a cross confirming that the bearish momentum might take place, right? So when you're looking at a trend and you want to know the overall trend, when we're talking about overall trend, we mean longer term. The 50 and the 200 is your friend. When you get crossovers of these, it's a bigger indication that which direction the market is moving in. So in this instance, because the 200 is a longer period, it tends to dictate the overall trend of the market, which is still on a downward momentum, right? Then what you'll also notice is the market is going to try and make an attempt here to shoot up again. So one of two things will happen. It can shoot through, right, through the 200, retest it, and then continue bullish, or the market can come, retest it, come back down, and just continue back down, test the 50, try again, something like that, and then down again. See, so the 200 is a very strong indication of what's happening overall. So if I were to maybe go, let's say, for example, to the weekly, you'd see how it interacts here. Like, in accordance with what we're seeing on the daily, you can see a bullish attempt is being made. When you go to the weekly, you get confirmation that, hey, we might see bullish behavior coming in here, right? The important thing here, guys, is to remember that you cannot, under no circumstances, trade off MAs by itself. That's a major thing for you guys to take into consideration. So, for example, here we know we're bullish. We've not nicked the 200 just yet. However, we are in a little bit of a falling wedge here, right? Or like a channel, like a flag channel, which is a bullish indicator for us. Coincidentally, look where the 200 is and the 50 is above. If the 50 is above the 200, we are still very much in a bullish market. And if the 200 is above and the 50 is below, we are in a bearish market. So ideally, based on what you can see here, and this is simply based on the emails, we're testing the 50 to remain bullish. If we can hold this, we break out of the channel like so. If we can break out, catch a retest of the stream line, and we go, right? Alternatively, the 50 can lose that momentum, and what can happen is we'll come back in here, we test it, and we'll drop all the way down to test the 200 again. So ideally, you don't want to be taking trades when you are between the two. You kind of want to take it when both are showing you the same thing. So if this is a bullish trend, you want the market to be up here. If it's a bearish trend, you want the market to be down here, below them. Remember, 200 above, 50 below, we're in a bearish market. 50 above, 200 below, we're in a bullish market. And as this stands at the moment, we are actually in a bullish market on a longer time frame. So all you need to do is wait for the break of that line. Oopsie. Wait for the break of that line, right? Wait for the break of that line. And now we want to use the 50, 200 and the 8 and 14 all together. Now watch, guys. This is where things get really interesting, right? If I put them both together, look how beautifully this coincides, right? The 8 and the 14 are nice and apart from each other. So the further apart from each other they are, the stronger the confluence that it will move in that direction. We got multiple rejections off the 8 MA. Look there, we nicked the 8 MA right here. Bang, now we're going to be on our way up. The beautiful thing here, and this is where the kicker is, on the 4-hour time frame, the golden cross is already looking to form. The 50 is trying to push above and the 200 is trying to push below. The minute that crossover happens, we will more than likely break out of this candlestick and bam, we are in. Now that, along with our other confluences, is a brilliant thing to kind of have. So let's say hypothetically I were to take this NZD-USD trade, right? I will be waiting for the crossover here. I'll be waiting for a cross here and this below and the break of this line and get in at this area here. So one little tip or trick that I can show you guys, which is very handy, you can go here, add alert on EMA ribbon, right? Condition, then you go EMA number 4, number 3 is 50, is crossing value, then I add the value, and let's say hypothetically I wanted to tell me at 0.7 zeros, right? 0, 1, 2, 3, 4, right? Only once, create. Now automatically I have an alert here, right here. Yeah? So when this eventually rises up and this eventually goes down, I get alerted of that, meaning the minute that alert goes off, my price should be in around about this range here, and the golden cross would have taken place, meaning I can take the entry. Now when you use that, combined with your support and resistance, combined with market structure video, if you guys did miss the market structure video, I do recommend going to look for it. As you can see, we are making a series of higher lows, right? That's structure confirmation. I got a crossover of my EMA, and to make things a little bit more juicy, because like that's just how we do, we can take our Fibonacci, we pull it out, we take it on this level, bam. You see? So if this is my entry, let me just remove this quickly. If this is my entry over here, you can take it from here, actually, funny enough. Or if you want to take it from here, this will be your entry here. And we scale to a lower time frame, right? Let's go to maybe H1. So if your entry is up here, right? Let's say around about here, right? This is what your reward looks like. Sheer perfection, guys. Remember, when the market if the market wants to range like we covered earlier, right? If the market wants to range a little bit here, or maybe on a 4-hour chart, maybe it wants to range a little bit here, that's totally fine, because now we know if the 8 MA, which is far away, just remove the drawings, with the 8 MA is far away, there's a good possibility of us trying to retest here. And then once that happens, and once everything happens, the market would take shape, the 8 MA would have caught up, and coincidentally, bam, there we caught our entry. And that was solely based off our Fibonacci. So if you guys like the video, be sure to like and subscribe in the link below. Keep it more than average, guys, and if you do have questions, let us know.